much as the market expands and retraces, how do you calculate your expansion and retracement? By using the Fibonacci sequence. What are the key takeaways for the Fibonacci sequence today is that every expansion move retraces only at 100%. So a trend, if a strong trend has been identified, it's forming. It can never retrace somewhere else if it was a strong trend and if it was following the sequence. If it was following the sequence, there is no way it's supposed to retrace up until it reaches 100%. So that's the first giveaway and the takeaway home from this lesson. After every period of expansion comes a period of retracement. That's the second takeaway. And then lastly, retracement only covers up to 50% of the initial BOS, which is break-off structure or expansion move. So what we say is that when the market expands, it has to retrace. After the retracement, there will come the expansion. After the expansion, there has to come the retracement. So expansions are always 100%. Retracements are a good retracement, not a retracement, not a reversal, right? A retracement has to be, reversal and retracement could be almost similar, but reversal obviously mostly happens on the most critical points because let's say, going back into your supply and demand. Supply and demand just means support and resistance, right? The market is driven by supply and demand. You can do more of your researches on that, but I've been covering multiple examples in real life on how companies, how brands, how commodities, you understand, actually gain value. Every company, most of them start as private. As private, it means that they're not listed on a stock exchange for people of the public to actually purchase the stock. But once they publicize it, they list it on the stock exchange of the country. People can start buying shares on it, right? And they will have to be certain legal obligations and legal steps that the company has to comply with. Maybe they need to have a certain net worth before they can actually go public, or they need to have a certain level of employee or a track record of profit, right? So when they list it on the stock exchange, it will have something that they call the IPOs, or the initial IPOs are actually the initial public offering. So we find that, okay, some companies are listed at $280 for 1 unit of stock or for shares, right? Some companies are listed at, let's say, 500. It can be Apple, it can be Google, it can be Amazon. So the more people start to purchase those stocks do what? Give the company its value. It gives also even its capital to invest and also to do what? To expand. So you start to see that the more people actually buy a certain company stock, the more it gains in value. And then after getting to a certain point, those stocks can be more expensive to even existing member or maybe even to new members who can purchase the stock. It will only attract a certain market, right? Eventually, then there will be a little bit of a retracement. But a good retracement, it has to only go down to about 50% of the Fibonacci sequence. After there onwards, if the stock is going to gain, it is to expand after that retracement and gain the next possible value. Because with that, whatever previous value that they found, when the market retraces, they need to find a way to put more orders, to put better services, to put better products in order for the value of the stock to continue growing up. Because once the company gets more better product, Apple improves, then people will buy more shares of it because they can see the portfolio is gaining. Then from there onwards, the first expansion, by the way, from the initial IPO, from the strongest support or demand region, or from the strongest resistance or supply region, the first expansion, it can only be a move from 0 to 23.6%. But 0 to 23.6% of what? Of the main trend support and resistance. From that 0 to 100. Not just what you see on your daily. No, on your daily, it's a small thing. Certain things will be happening. Patterns will be coming up later on. But the real expansion on the market has to move from on your weekly and your monthly time frame. Remember, time frame gives you what? It gives you a perspective. That's the purpose of the time frame, to give you a perception of what the key levels that you find on the 5 minutes, how they can influence what you find on the 15 minutes, how the key levels that you find on the 15-30 can influence what you find on the daily, and vice versa. Now, top-down analysis means, okay, first you start on the top time frame to get a bigger perspective of the market. Once you analyze it like that, you go all the way down to the smallest time frame. So it means, okay, cool. If you're gonna look at the trend from the daily, the same thing that you do on the daily, also do them on the weeklies, but starting from the order of the bigger time frame. If I'm going to be looking at my support and resistance on the monthly, I first have to find it there. And then next to that, I got to look at my expansion. Did my monthly expansion move from 0 to 23.6% of the main trend? If not, where is it in relation to them? Maybe it's at 12%, maybe it's at 1%. If it's at 1%, what are the chances that the trend is gaining? Because Fibonacci says only progress and expansion comes after at least you tap on 23.6%. So you can use the same concept also on a small time frame. But how about you first align yourself with the biggest time frame, which will give you a bigger, strongest key level, trends, patterns, and expansion phases that can also even correspond with what you see on the smallest time frame. Because so far we've seen that, the moment you see a candlestick, right? The moment you see a candlestick, you realize that a candlestick has an opening and also even what? And also even a closing price, right? So when you see a candlestick, let's say you see a bull candlestick, mostly signified as a green color, or like whatever the case it may be, right? What does a candlestick actually represent? It represents the volume and the liquidity on the market. The volume, it's exactly what you find on the body of the candlestick or the shaded structure. You see the entire structure where you see it's covered, because the structure of a candlestick, we know for a fact, it also have things like wicks. Within those wicks, that's where your volatility is at. Those wicks, your volatility is covered by your highs and your lows for that particular candlestick time frame. Now remember, each candlestick on the time frame that you'll be tapped in on. Let's say, okay, cool. We have this one. Those are the highs and the lows. These are the highs and